Hello everyone, welcome back to our channel. All right, today I'm gonna share to you how to make money through index investing. So guys, if you have yet to subscribe, please subscribe to our channel. We will really appreciate it. Okay, so guys, today I'm gonna share to you how to make money through index investing. This is one of the easiest way to make money through the stock market. And I'm gonna share to you the step by step, right? And the return that you're going to get when you invest through index, right? So this is an index investing methodology. So I believe it's going to help you a lot. So let's go through the slides, right? So these are the skills and strategy that I'm going to go through with you today, all right? So let's go through. Now, index investing is one of the best way to invest, right? Generally, in the long term, the stock market always go up because of inflation, because of sales, right? As company continue to evolve, stock market generally always goes up. So what is index investing? Index investing is a passive investment technique that attempts to generate returns similar to a broad market index. So basically, when you invest in an index, you are basically investing through various company sizes and sector for that particular index. Say, for example, S&P 500. If you're investing through S&P 500 index, you're basically investing in the best 500 companies in the US. So let's look at some statistics. So you can see over here that if you invest in the Dow Jones, right? If you invest in the Dow Jones, you can see that the performance has been very, very good over the long term since 2014 until 2021. If you invest in the Dow Jones or SPX, right? You will gain at least 118% return, all right? So, but if you invest in the KLSE stock exchange, right, you will be down for 13%. So it's also important to pick which index to invest in, right? So it seems that over the long term, SPX or the US stock market are more stable. Overall, SPX has gone up about 180% for the past 7 years, while KLSE has dropped by 13%. So it seems that US stocks has performed much better versus KLSE stocks since 2014. Let's look at some more data. Let's look at the stock market average annualized return over the past 10 years, 30 years, and 50 years using the S&P 500 as a proxy for the market. So these are some data. If you invest for 10 years since 2011 to 2020, you will have an annualized return of 13.9%. If you have been investing for the past 30 years, since 1991 to 2020, you will get 10.7%. But if you have been investing for the past 50 years, since 1971 to 2020, the annualized return is actually 10.9%. That is quite a good return. So, but guys, in the short term, anything can happen, right? So we need to really look at the long term. Do you know that over that period of 50 years, 18 years of that will give you a return of 20% or more? But for about 13 years of those 50 years, you will only get returns about 10 to 20%. 9 years, okay, of that, you will get a return between 0 and 10%, right? So, and if you invest only 5 years, okay, there are 5 years, right, out of that period, you will get between 0 to 10%. Actually, sorry, it's a losses between 0 to 10%. And if you, and out of that period, there's 2 years that you have losses between 20 to 20%, and there's 3 years they have losses more than 20%. So these are the statistics, right? We captured some data from 1957 to 2006. So you can see some of those here will give you very good return, like this one 36.90%, 8%, 24%, 18%. But over the short term, you can see sometimes it give you a drop of 13%, drop 3%, drop 11%. Since year 2000, you drop 10%, 2001 drop 13%, right? So over the short term, right, some years will have a drop, but over the long term, right, most of the time it is actually going up. So let's look at more data here. right? So if you invest 1,000 ringgit per year over the period of 35 years with an annual rate of 10.9%, just like what we see just now in this chart. If you invest over the long term, assuming that you only get 10.9%, if you invest over the long term for 35 years, compounding annually, you will actually get almost 4 million plus, right? So it's quite a huge amount. What if you only invest in certain product where it only give you about an annualized return rate of about 7%? Of course, you invest 1,000 per month over the period of 35 years, compounding annually, you still get 1.6 million. But if you invest in passive index investing, you can actually get 10.9%. 7 to 8% is a typical, promised by a certain unit trust fund. But even if you invest in an index, right, it's a passive investment, you can even get 4 million. Now, the US stock market has been very resilient throughout the history. Let's look at some data. Since 1936 until the year 2020, multiple events has been happening, right? And we sometimes deem this as bad events, right? So no matter what is happening throughout the years, right? More than 70 years, the US stock market has continued to be resilient. And for those years that are being highlighted in red, those are the years that are having recession. So even no matter what is happening, even there are recession, short-term recession, long-term recession, the US stock market continue to go up regardless of recession, World War II market crash, Korean War, Vietnam War, OPEC oil embargo crisis, Iranian revolution, energy crisis, HIV/AIDS, Black Monday. This is the famous Black Monday in 1987, the Gulf War, the Oklahoma City bombing, ASEAN currency crisis in 1997, 9/11, the tech bubble burst, the global financial crisis, right? H1N1, swine flu, MERS, Ebola, SARS also happened here. There's a big drop here. Ebola, and we know 2 years ago we have a trade war between US and China, and most recently last year we have the COVID-19 pandemic. But regardless what is happening, the stock market has been continued to grind up. In fact, since last week, for the past few days in July 2021, the stock market has been making all-time high. Okay, so you may be asking, how do you buy the US stock market? You can actually invest through SPTR S&P 500 ETF Trust, also known as SPY ETF. But anyway, guys, if you have yet to subscribe, please remember to subscribe. Click the like button, smash the subscribe button, and please comment what have you learned so far. Right, let's continue. So if you look at the S&P 500 stock market, it has been going up all this while since 2012 to 2021, and the time the SPY ETF is ranging about 125, now it's almost hit $400, right? So do you know that you can actually buy a minimum of one stock in the US? And if you want to invest in a KLSE index, you actually need to buy a minimum of 100 shares. And for Hong Kong, you need to buy a minimum of, depending on what our ETF, right? It will be costing you 100, 500, 1,000, 2,000 shares. But anyway, today we are focusing on US stock market. You can buy the SPY ETF. You can buy a minimum of one stock. So you may be asking again, when do you buy the index? You buy when the price retraces to the moving average line. So for this, you need to learn a little bit of technical analysis. We also call this buy the dip strategy. So this is an example. So I have plotted here the SPY ETF, right? And then I plotted also the tree line, the moving average. The blue color is a 50 days moving average. The green color is 150 days moving average. And the red color is the 200 days moving average. So I also drawn some arrows here where you can actually buy certain number of shares during that dip. So for example, when the share price of SPY ETF touches the 50 days or 150 days, you can nimble a bit and buy a bit. Here it dropped to, again, the 50 days moving average line, it touches, you buy a bit. Here also, you can buy a bit. But when the share price has been going down all the way, when it is in a downtrend, and the moving average line has actually crossed, is suggested that you don't buy so much. You can buy a little bit, but because it's in a downtrend, low can go lower. You want to buy when it's like a confirmed uptrend. So now the share price have reverses in slope, and also you can see the moving average has actually reverses in trend. But of course, here is the most this is more safe because the moving average, 50 days moving average, has crossed above 150 days and 200 days moving average, right? So then when this dip here, you can buy a bit, dip here, you can buy a bit, and then dip here, you can buy a bit, Every time when it dips, right, you can buy a bit. So this is actually called buying the dip. So as a conclusion, you buy when the moving average is the 50 days moving average line is above 150, and 150 days moving average line is above 200. And you buy when the share price touches the 50, 150 or 200 days moving average. So you don't buy at all time, all at once, but you buy in batches, right? So when you bought the index, right, should you buy and hold? Or should you sell when it is high and buy back when it is low? This is one of the frequently asked questions, right? When you buy and hold, we call this time in the market. But when you sell when it's high and buy back when it's low, we call this timing the market. So which strategy is actually more profitable? Let's look at some statistic here. We actually know that it is better to buy and hold. Let's look at some data here. If you invested all days, meaning you buy and hold, if you put in the initial 100K investment, you will actually get 272,000 over the long term, right? If you invest, if you have been investing for the past 10 years. What if you time the market? Sometimes you are out of the market. If you miss the best 10 days, you will actually grow your money about 50% only. Here is almost like 2.5 times. Here is only 50%. What if you miss the 20 best days? You only earn a little bit, right? What if you miss the 30 best days? You will actually have a lower, your capital will depreciate, right? You will make a loss versus your initial 100K investment. But what if you miss a 40 best days? Your money will actually, drop up to 64,000 only. So the key lesson here is to keep on invested at all time. So it's not about time in the market, but timing the market, because no matter what is happening, sometimes we thought that when event happen, the market will drop. It's better to sell, and buy back at the low, but you will never know what will happen in the future. So regardless of what's happening, it's important that you stay in the market, right? Let the market continue to go up, and let the compounding effect, play in your favor. Okay, so guys, time in the market is better than timing the market. So thank you guys for listening to our video today. Please again remember to subscribe, and we hope that we're gonna share to you more upcoming helpful video for you guys to help you in your financial literacy. Thank you guys.